In the world of finance, a storm is brewing. Unseen, unheard, but its effects felt by everyone. Imagine being on a boat in the middle of a serene ocean. The water is calm, the sky is clear, and everything appears to be in perfect harmony. But beneath the surface, a tempest is gathering strength. This is the current state of our stock market. On the surface, it seems to be performing well, with indices hitting new highs. But beneath the tranquil facade, there's a growing sense of unease. The market's volatility is increasing, with sudden dips and spikes becoming more frequent. Investors, both seasoned and new, are growing anxious. The fear is not unwarranted. The specter of a stock market crash looms large. It's a concept that sends shivers down the spine of even the most hardened Wall Street veteran. A crash is not just a drop in stock prices. It's a precipitous, uncontrolled fall that can wipe out billions of dollars in wealth in an instant. It can turn fortunes into dust and bring entire economies to their knees. But what is it about our current market situation that has investors on edge? Well, there are a few factors at play. The first is the sheer unpredictability of the market. Despite all our advances in technology and financial modeling, the market remains a beast that refuses to be tamed. It moves in ways that defy logic and confound experts. This unpredictability, coupled with the high stakes involved, is causing a lot of sleepless nights. The second factor is the unprecedented level of speculation. With easy access to trading platforms and a surge in retail investors, the market has become a playground for speculation. But as history has shown us, speculation can inflate bubbles, and when these bubbles burst, they leave destruction in their wake. But what are the reasons behind this predicted storm? Let's unravel this mystery. The stock market, in all its glory, is essentially a bubble, and every bubble is destined to burst. To understand this, let's imagine a soap bubble. The more air you blow into it, the larger it grows. Similarly, in a stock market, the bubble is created when investors pump in more and more money. As they buy stocks, the demand increases, and with it, the prices. The market value of the stocks starts to inflate, often beyond their intrinsic value. This is the formation of a bubble, an economic cycle characterized by a surge in asset prices unwarranted by the fundamentals of the asset itself. But what happens when you keep blowing air into a soap bubble? It eventually pops. In the stock market, this is the burst. The inflated prices cannot be sustained indefinitely. There comes a point when the investors realize that the stocks are overvalued. Panic sets in, and they start to sell off their stocks, leading to a sharp drop in prices. Now, where does the Federal Reserve fit into this picture? The Fed plays a crucial role in controlling the money supply in the economy. They can raise or lower interest rates to either encourage or discourage borrowing. When the Fed increases the interest rates, borrowing becomes expensive. This discourages investors from borrowing money to invest in the stock market. The demand for stocks decreases, and the prices start to fall. This can trigger the burst of the bubble. But it's not just about the interest rates. The Fed also has the power to control the money supply through open market operations, which involves the buying and selling of government securities. When the Fed sells these securities, it removes money from the economy, making it harder for investors to get their hands on cash to invest. This too can lead to a decrease in demand for stocks and the subsequent burst of the bubble. So the bubble bursts and the market crashes, but what exactly triggers it? A crash doesn't happen out of the blue. There are triggers, warning signs that we often overlook. Consider a game of dominoes. Each tile precariously balanced, waiting for a nudge to send it tumbling. That's what our economy is like, a delicate balance, and the triggers of a stock market crash are those nudges, the fingers that tip the first domino. One such trigger is high inflation. When the cost of goods and services increases rapidly, it creates uncertainty in the market. Investors may pull out fearing that their investments will lose value. This can lead to a domino effect, where one investor's fear triggers the next, causing a rapid sell-off of stocks. Then we have low employment. When fewer people are working, fewer people are spending. This can lead to a decrease in corporate profits, which in turn can lead to a decrease in stock prices. If this happens on a large scale, it can trigger a market crash. High interest rates are another trigger. When it becomes more expensive to borrow money, companies may cut back on expansion, slowing economic growth. This can cause investors to lose confidence and sell their stocks, potentially triggering a crash. Lastly, a slowdown in economic growth can be a major trigger. When the economy isn't growing as fast as expected, it can cause a ripple effect throughout the stock market. Investors may become nervous, selling off their stocks and triggering a market crash. These triggers, while not always predictable, are signals that the balance of our economic dominoes may be about to tip. They're the warning signs we often overlook, the indicators that a crash may be on the horizon. These triggers push the market off the edge, leading to a crash. But how does it impact us? A stock market crash is like a domino effect. It doesn't just impact the investors, but the entire economy. Indeed, when a stock market crash occurs, it's not just the traders and brokers who feel the heat. The ripples extend far and wide, reaching the most unexpected corners of the economy. It's as if a giant, invisible hand has knocked over the first domino, causing a chain reaction that leaves no stone unturned. Let's start with businesses. When the market crashes, companies lose their value, and with that, their ability to raise funds diminishes. This can lead to a lack of investment, stalled growth, and in severe cases, business closures. The once thriving enterprises that were the lifeblood of our economy are reduced to mere shells of their former selves, but the domino effect doesn't stop there. When businesses suffer, so do the people they employ. Job losses become rampant as companies scramble to cut costs and stay afloat. This leads to a rise in unemployment, which in turn reduces consumer spending. When people are unsure about their financial future, they hold on to their money tighter than ever, further slowing the economy. This leads us to the next domino in line, the economy itself. A stock market crash can trigger a full-blown economic recession. As businesses close and unemployment rises, the economy contracts, leading to a vicious cycle of negative growth. This can last for months, or even years, depending on the severity of the crash and the resilience of the economy. The domino effect of a stock market crash is a grim scenario, one that paints a bleak picture of our financial landscape. It's a stark reminder of how interconnected our economic system truly is, and how a disturbance in one part can create shockwaves that reverberate throughout the entire structure. A stock market crash is a devastating event, but can we predict it, or better yet, prevent it? Only time and our subsequent discussions will tell. Predicting a stock market crash is like predicting the weather. It's not always accurate, but it's worth a try. Imagine standing in front of a complex weather map, your eyes darting between swirling storm systems and pressure gradients. Now replace that weather map with dynamic graphs of stock prices, economic indicators, and financial models. That's the landscape of an economist or analyst trying to predict a market crash. There are certain economic indicators that these experts keep a close eye on. GDP growth rates, employment statistics, inflation rates, these are the pulse points of an economy. When these indicators start to falter or behave erratically, it could be a sign of an impending crash. But just like a sudden shift in wind direction doesn't necessarily mean a storm is coming, these indicators aren't foolproof. Financial models built on complex algorithms and historical data are another tool used to predict crashes. These models try to detect patterns and trends in market behavior that might signal a crash is on the horizon. However, these models are only as good as their inputs. If they're fed inaccurate or incomplete data, their predictions can be wildly off the mark. And let's not forget about the human element. The market is driven by the collective behavior of everyone participating in it. Fear can trigger a crash just as easily as a real economic downturn. That's why analysts often keep their ears to the ground, gauging market sentiment alongside hard data. Yet, despite all these tools and techniques, predicting a crash is still a formidable challenge. It's like trying to predict exactly when and where a lightning bolt will strike. We can estimate, we can guess, but we can never be completely certain. While we can't always predict or prevent a crash, we can certainly prepare for it. The storm is inevitable, but with the right preparation, we can weather it. The looming threat of a stock market crash is not a sign to retreat, but rather a call to action. It is a moment to fortify our financial defenses and strategize for the turbulence ahead. Now, how does one prepare for such a storm? The first and essential step is diversification. It's an age-old saying in finance, don't put all your eggs in one basket. Spread your investments across various sectors, countries, and asset classes. This way, if one area suffers during the crash, others may remain stable or even thrive, balancing out potential losses. Next, let's talk about risk management. This involves understanding the level of risk you're comfortable with and aligning your investment strategy accordingly. If the thought of a crash sends shivers down your spine, it might be wise to lean towards safer, more stable investments, such as bonds or blue-chip stocks. On the other hand, if you're willing to ride the wave, high-risk, high-reward investments might be more your speed. But remember, the higher the risk, the greater the potential fall. Lastly, financial planning is key. This is not just about investing but also about saving and spending. Build an emergency fund that can cover at least 6 months of living expenses. This can act as a financial cushion during turbulent times. Also, consider reducing unnecessary expenses and prioritizing debt repayment. A leaner budget and less debt mean more resilience in the face of a crash. In the face of the storm, knowledge is your best tool. Stay informed about market trends, economic indicators, and global events that could impact your investments, and don't hesitate to seek advice from financial advisors or experts. Remember, a stock market crash isn't the end of the world. It's a cycle, a natural part of the economic ecosystem, and like all storms, it will pass. The storm may be fierce, but with the right preparation, we can come out on the other side, stronger and wiser. Every storm passes, and so will this one, but what happens next? In the aftermath of a stock market crash, we find ourselves standing in a landscape altered by the storm. The economic terrain may seem unfamiliar, scarred by the ferocity of the crash, but it's important to remember that this is fertile ground for growth and recovery. The storm may have uprooted foundations and disrupted the status quo, but it has also stripped away the illusion of invulnerability. It has shown us the vulnerabilities in our economic systems, the weak points that need reinforcement. And with this knowledge, we can rebuild, stronger and more resilient than before. Look at the stock market crash as a reset button of sorts, a chance to recalibrate and refocus. With the excesses of the past flushed out, the economy can start afresh, unburdened by the weight of unsustainable growth. It's a time for companies to innovate, for industries to adapt, for investors to diversify. It's also a time for learning. The crash will have laid bare the risks and rewards of the market, the importance of prudence and preparedness. Investors will have learned the hard way about the dangers of speculation, the pitfalls of chasing quick profits over sustainable growth. But it's from these harsh lessons that wisdom is born, shaping more informed, more cautious market participants. Remember, it's not the storm but how we respond to it that defines us. The economy may falter, the market may crash, but our capacity for resilience, for innovation, for growth remains undimmed. Out of the ashes of the crash, new opportunities will arise, new paths to prosperity will be forged. The storm may be fierce, but it's also an opportunity for growth and learning. Remember, the sun always shines after the storm. In conclusion, a stock market crash is more than just a drop in stock prices. It's a ripple effect that impacts the entire economy. We've traveled through the unseen storm, examined the bubble and its inevitable burst, and dissected the triggers of a crash. We've also delved into the domino effect, the potential widespread consequences that can follow a crash. We've discussed the unpredictability of these crashes, yet also highlighted the signs and trends that can hint at a looming storm. We've underscored the importance of preparation, of fortifying ourselves and our finances against the potential impact. And finally, we've looked at the calm after the storm, the potential for recovery, and the growth that can emerge from the ashes of a crash. Remember, while we can't always prevent these economic downturns, we can arm ourselves with knowledge and strategies to navigate through them. The storm may be fierce, but with knowledge and preparation, we can weather it. Until next time, stay informed, stay prepared.